So now this is going to be very, very high level, but this is just to let you know like what a 50-year-old preferred non-tobacco, non-finance life insurance policy would look like. And if you own life insurance, you may have something very similar. So what you're seeing here is that 50-year-old puts in $300,000 for 20 years. So that's what they call a 20 pay. So they're putting in a total of $6 million. From the very beginning, there's a death benefit of $20 million. So put in 300,000 and you get a $20 million death benefit. That $20 million does not grow. You can see that full time period. They can obviously borrow from this as well. There are some values of being able to borrow. In this particular case, we looked at it where it was just a guaranteed universal life policy where they weren't actually having any cash value. This is the most inexpensive way to just create a legacy that's guaranteed off of 6 million. But we're not here to talk about regular life insurance. We're here to talk about what does that look like to finance that same opportunity. So what we did here is that same 50-year-old, we're showing here in the column is this is money they're able to borrow. And again, that $10 million is really the area where most banks are looking for. So looking for that individual that's worth 10 million or more. If you're below that, still work with us. We have other programs that do work with you where you are not using leverage life. But in this scenario, we're borrowing a total of $10 million. Now, here is the interesting part about how leveraging works. The $10 million is borrowed from the bank. You're out of pocket cash flow. Again, this is just a rough idea. It could be more or less of how we plan this. But in this case, we're only paying the interest of $125,000 a year. So the actual outflow for that individual here is 1.25 million. And what you can see here on that far right corner, 20 million, 19 million is where it's starting off. It starts growing to 20 million, keeps growing, growing, growing. Again, these are hypotheticals, but this is based off of how the indexed universal life strategy. So instead of having a $20 million death benefit and paying $6 million out of pocket like the whole life policy was, in this particular case, if they died at age 88, you're looking at a $45 million tax-free death benefit, and the loan is being paid back as well. So you can see here, just to highlight the key factor here, that death benefit grew to $81 million. There is a loan balance there. And then there's also cash value that's associated with this. So this particular policy, the way we build it is there's also actual extra collateral needs to be held outside the policy. So again, the reason why banks love this is 100% of their loan is going to be protected. So that's where that very low default risk is. So, they have the loan balance. So if death were to occur in the first year, 2 years, 3 years, 5 years, that death benefit is going to be paying back the loan balance. But in addition to the cash value, there's also a collateral projection that is needed. So Joel, you want to come off and talk a little bit more about how that loan process works?
Yeah, sure. I'll also just highlight the overall flexibility of this. This is based on a 50-year-old looking at Penn Mutual specifically, sort of a standard 7-pay scenario. Depending on age, health, ultimate carrier that we go with, ultimate banking arrangements, it could only need a 5-pay, which would, be sort of less stress on the whole plan, or it might need 10 years of premium to ultimately get the desired results. But yeah, basically that year one would happen. You would we've closed these arrangements with over a dozen banks from, private banks to leveraged life specific banks. You would borrow that $1.4 million. It would go straight into the life insurance plan. You would pay $125,000 to the bank, which in that first year scenario would cover the $82,000 of interest that would be due based on a 5.75% initial lending rate. And then the rest would go into the loan principal. That lending rate is a real world scenario that high net worth individuals can ultimately get. And then we are driving that rate down to 4%, which is more or less a long term average. when we went and we would, customize these plans for you individually, that can definitely be a discussion on where you see those rates going. And then we would also ultimately stress test the policies and show you in worse lending rate environments what it would look like, and policy underperformance as well. So you could really see, sort of the worst case scenario, and ultimately that the plan still would work out and look really attractive.
Thanks, Joel. And for those that are on the call, so if you're worth $20 million right now, we're really looking at using, 1/20 of your portfolio over the next 10 years to really create that lasting legacy. And this far right-hand column, what you're seeing there is that's the net IRR from the death benefit. So going out to age 88, you can still see that that is a tax-free 11% rate of return to your beneficiaries based off of using life insurance. Again, this is what we really look at as that legacy play. So wherever you're worth now, like we go put that into our calculators and we try to estimate where your net worth is going to be in the future, to most importantly to help you offset taxes. Again, love to be able to reach with you. Please set up a meeting with us to kind of go over if this is a strategy it would work with you. You may be uninsurable. We may look at using a spouse. We have what's called a second to die policy, where we can have an uninsured spouse with an insured spouse, and these policies work very, very well with that. Typically, when you do sit down with us, your consultation email, and once you click on it, you're going to give us all the basic information. So we'd like to have our illustration in hand, at least a hypothetical illustration that fits your needs, and then we'd really start tailoring it down. We'll look at getting underwriting involved. We'll look at getting some soft pulls off your medical history to see, in this particular case, we're showing this for a preferred non-tobacco smoker where we're dealing here. So this is our finance life leverage, using it for a legacy play. Really, most importantly, especially for those that have illiquid assets, whether your money's in your business, whether your money's in real estate, this money is going to be typically within 2 weeks time period. Once a death certificate is delivered, that would be either in your estate or in your irrevocable life insurance trust, creating that liquidity event that you aren't necessarily going to have to do to sell businesses to pay the estate planning tax.